Are stocks set to soar even higher in the wake of the Fed's rate cut? We explore that in this week's Fastest 4 Minutes in Finance. Hello, I'm Scott Inman. Well, we are technically entering the second year of the Fed's rate-cutting cycle. The first cut came in September of 2024, and we got another one just this week. It is what investors wanted, and they finally got it. Of course, the Fed's decision to cut rates is dependent on economic data. If they cut rates, it's because they believe the economy is slowing down. The unemployment rate is ticking up, and inflation has cooled, although it remains above their 2% target. So if the economy is slowing down to the point that the Fed made a move, you would think the stock market might contract. Well, it turns out it depends. If the economy avoids recession, the stock market actually has performed quite well in the second year of a rate-cutting cycle. Here's a chart from LPL Research that backs it up. This shows us rate-cutting cycles over the past 50 years. The blue line represents the return of the S&P 500 index in the year following the first cut. The orange line represents the return in the second year after the first cut. The average gain during year one is 9.6%, and the median gain 16.4%. The index is up about 17% this time around. So in year two, well, the average gain was 16.4%, and the median was 14.4%. So historically speaking, stocks may do very well in the next 12 months. But there are some negative returns in there. 3 times in the 10 rate cutting cycles measured, the index was down in year two: 1981, 2002, and 2008. And in all 3 of those, the economy entered a recession. So whether or not stocks go up from here greatly depends on whether we enter a recession or not. And unfortunately, we won't know that likely until after it happens. LPL Research believes economic growth will continue in 2026, powered by stable interest rates, cooling inflation, fiscal stimulus, continued robust artificial intelligence investment, productivity gains, and more rate cuts. Of course, on balance, there are headwinds that could disrupt that course. LPL points out deficit spending may put pressure on long-term interest rates. A stalled job market may spark recession fears, and legal challenges to tariffs bring uncertainty. So as always, it comes down to controlling what you can control. Never bet at all on a prediction of either direction of the stock market in the next 12 months, and stay diversified and stick to your plan for financial independence. Want to become smarter financially in 4 minutes or less? Sign up at fastest4.com to get insights and updates like this delivered to your inbox weekly.